The latest inflation data is out, and it says that consumers, regular people, saw the price of regular things, their cost of living, go up by 6.8% between November 2020 and November 2021. So essentially almost a 7% increase in the cost of living. So if your wages did not go up by 7% over the last year, then you effectively became poorer because now it's costing you 7% more to live your life. But even that 7% number isn't telling you the whole story. So now we have this inflation issue, and the Federal Reserve Bank and the government are still doing very little. So I waited to make this video because I saw the inflation numbers, and then I wanted to see what the Federal Reserve Bank was going to say. And also, I'm here in Florida right now, so I'm not in the office, which is why the backdrop might look a little bit different because this is my portable backdrop. But I wanted to see what the Federal Reserve Bank was going to say. And not surprisingly, they're not doing much. So the big story is that the United States has not seen inflation this bad since 1982. And back then in 1982 and the 1970s, we were in a period of stagflation. It was a time where we saw high inflation and high unemployment. So the economy was not growing, and at the same time, inflation kept skyrocketing. And this created essentially a dollar crisis. And then to combat this high inflation in the 1980s, that's when you saw the Federal Reserve Bank raise interest rates significantly. So if you wanted to go out and get a mortgage in the early 1980s, it wasn't going to cost you 3% a year. It was going to cost you 18.5% a year, because that was the only way that they could shrink the monetary supply, and that was the only way that they could control the dollar and stop a potential dollar crash. Now here we are going into 2022, we have record high inflation, and the Federal Reserve Bank and the government keep saying that inflation is now just going to cool down magically by the middle part of 2022, and that's when the Federal Reserve Bank will start to raise interest rates to start combating inflation then. They keep saying that, okay, we're gonna slow down this tapering, meaning they're going to slow down quantitative easing right now, meaning the Federal Reserve Bank is still doing quantitative easing, which is the thing that causes inflation. So while the Fed says that they want to slow down quantitative easing, they're still doing the thing that causes inflation. So they're still creating more inflation. And then sometime in 2022, that's when they're going to work to help slow down inflation by raising interest rates. But this really doesn't make any sense, because if you look at what the CPI numbers tell you, it's actually a little bit worse, or a lot of it worse, than what the government and what these numbers say. CPI stands for Consumer Price Index, and what it's supposed to do is give you an idea of how much the price of things are going up for consumers. Regular people, so people like you and me, how much more do you have to pay for your cost of living today versus a year ago? The problem is the CPI numbers that we have today don't give you a real accurate depiction of the inflation that people are actually experiencing. And the numbers that you saw in 1982, what everyone's comparing our inflation numbers to, well, that was a different CPI indicator that we have now. This Investopedia diagram goes over the 8 sectors that's included in CPI. You have apparel, you have transportation, you have education and communication, you have other goods and services, you have recreation, medical care, food and beverage, and housing. So you have a whole bunch of economists that are looking at the price of things like food, they're comparing it to what it cost a year ago and a month ago, and then they put all these numbers into the CPI algorithm, and then out comes a CPI number. And in this case, we're seeing a 6% growth between November 2020 and November 2021 with the annualized number. Now, all of this data is public information, so anybody can go and look at it, but they try to make it kind of confusing to understand that where the average person cannot understand what's going on. But I'm a money nerd, so I decided to look a little bit deeper into it. So the Bureau of Labor Statistics released an inflation report, and they showed that shelter, housing, makes up a big portion of their CPI, which makes sense because for most Americans, housing is your biggest cost. It says on the report that owner's equivalent rent of residence makes up 23.514% of the total CPI data. So the owner's equivalent rent makes up pretty much a fourth of CPI. Now, if you're wondering why in the world they call your housing costs owner's equivalent rent instead of just calling it housing costs, well, I'll get to that in just a second. Now, unless you live under a box, chances are you've noticed that housing costs have gone up. Well, if you look into the CPI report released by the Bureau of Labor Statistics, it says that the owner's equivalent rent, which is a quarter of the entire CPI data, it says that the housing costs have gone up between November 20 and November 2021 by 3.5%. So it says that our housing costs, which makes up a quarter of the CPI data, I cannot emphasize this enough, 25% of the CPI data is your housing costs, and it says that your housing costs have gone up by 3.5% between November 2020 and November 2021. Does something seem a little bit fishy there? If it does, it's because this is a massaged number. So going back to what I said earlier, why don't they call this housing costs? Because it's not housing costs. There's a reason why they call it owner's equivalent rent of residences. Because what they don't do is they don't look at housing prices and see how much housing prices have gone up. And what they don't do is they don't look at rental costs and to see how much rental costs have gone up. What they do is they call up random homeowners and they say, if you were gonna rent your home out this year, how much would you charge for rent? How much do you think your home is worth for rent? Then they take that data and they input that into the numbers. And then they give that data, which homeowners give, and then they input that into the CPI report, and that's how they come up with the numbers. And now you might be wondering, why in the world don't they just look at rental prices instead of calling homeowners to ask them what they would charge for rent? That's a pretty logical thing to say, but you have to remember, this is not a logic contest, because if we went logically and now we included actual rent costs instead of asking random homeowners what they would charge for rent, because you probably have no idea what you would charge for rent if you're living in your home and you have no intention to rent out your home. But if they actually looked at rental costs, because we've seen rental costs go up by what, 10, 15% in some areas, 10 or 15%, if you add that in, well, now inflation looks like it's a whole lot worse. And if inflation looks a whole lot worse, well, that doesn't look so good for the government. And who's reporting the CPI data? Oh, the government. So if the government is getting to grade their own inflation, why would they want to say inflation is actually bad when they could just massage the numbers and then say inflation isn't as bad? Now, inflation is bad. Even with the CPI numbers, inflation is out of control. But what they're trying to do is make it seem less out of control than it actually is. Now, before you go out and write me this crazy comment saying, Jaspreet, you're just a conspiracy theorist, that doesn't make any sense, let me actually just read you what owner's equivalent rent is. That way you can make the decision for yourself. So let's go on to this Investopedia article. What it says is, in the key takeaways, owner's equivalent rent measures how much money a property owner would have to pay in rent to be equivalent to their cost of ownership. It's used to measure the value of real estate markets, where it can help direct individuals to either buy or rent a home, and it tends to be linked to inflation. So the Bureau of Labor Statistics has this pie chart which helps them come up with the CPI number. 23.5% of your CPI is this owner's equivalent rent, which is supposed to give you an idea of housing costs. What they said is the housing costs have only gone up by 3.5% between November 2020 and November 2021. And the reason why they say it's only gone up by 3.5% is because they're not looking at actual rental costs or the actual costs that people are paying. What they're saying is they're surveying homeowners and asking them how much they would rent their home out for, or what they think their home should be rented for. And based off of those numbers, not what somebody's actually paying, based off of those numbers, they say the housing costs have gone up by 3.5% between 2020 and 2021, and because of that, inflation is as low as it is right now, which is 6.8%, which is not low at all. Now, this is just one reason why CPI is not a real reflection of the new cost, the higher cost that you have to pay today. I mean, you can even take a look at things like substitution. Investopedia released an article titled "Why CPI is Controversial," and you can go under there and see this whole thing of substitution. Substitution says that it is the change in purchases by consumers in response to price changes. So what that means is, let's assume that the prices of things start to go up, and because they've gone up so much, you say that I can no longer afford what I wanted to buy, so I'm going to go out and buy something cheaper, something not as good quality. And because people are doing that, that's when the CPI data says, oh, your cost of living hasn't actually gone up because now you're buying something cheaper, so your cost of living has actually stayed the same, when in actuality, the only reason why you're buying this cheaper good is because you couldn't afford the nicer product. Peter Schiff always gives the example of steak versus chicken, where if you wanted to go out and buy steak, you're buying steak, but then the price of steak keeps going up because inflation, steak gets so expensive, so now you're gonna go out and buy chicken just because you can't afford steak anymore. So then what the CPI data does is to say, oh, well, your cost of food hasn't gone up because now you're buying chicken instead of steak. But the reason why you're buying chicken is because, well, it's cheaper than steak, and that's not included in the CPI. Another example of this is just thinking of buying cereal. You want to go out and buy some Cinnamon Toast Crunch because you know that Cinnamon Toast Crunch is good, But the price of Cinnamon Toast Crunch keeps going up because of inflation, and now you can't afford Cinnamon Toast Crunch. So what do? You buy the generic Walmart brand of Cinnamon Toast Crunch. It's not Cinnamon Toast Crunch, it's Cinnamon Toast Munch. You know what I'm talking about? The generic cereal. So what CPI does is they see what people are buying now because they can no longer afford the nicer products, and then they take that number out of the CPI, even though the reason why you're not buying the nicer stuff is because you can't afford it anymore. So they adjust this in the CPI, and they lower the CPI, they lower the inflation numbers because you're spending less money because you're buying cheaper stuff, when in actuality, the reason why you can't buy it is because you cannot afford it. So CPI doesn't give you a real measure of your cost of living growth because they take out your higher cost of living and the things you can't afford because that's what inflation is. The reason why I'm talking about all this right now is because everybody keeps comparing our economy and our inflation right now to the inflation that we saw in 1982. That's what the article says. We're seeing the highest inflation since 1982, except you're not comparing the same things because in 1982, you did not have the same type of CPI data as we had now. Back then, they actually looked at housing costs. They don't look at owner's equivalent rent. Why? Because the government changed the CPI measure between these two decades, between these two eras, because they wanted to create a new CPI measure that would make the government look better. So this can pretty much go one of two ways. Either the Federal Reserve Bank is right, somehow this inflation is going to cool off, things are going to magically get better, and by the middle part of 2022, we're going to see inflation magically come back down to 2% a year. They've already admitted that inflation is not transitory. They said that they were wrong about inflation. But what they're saying now is that this high inflation that we're seeing is still gonna cool down by the middle part of 2022 pretty much magically, because they're not doing anything to stop inflation. They're saying that they will taper faster, but all that means is they're gonna do less quantitative easing, which means they're gonna cause less additional inflation. They're not doing anything to slow down the actual inflation that we have right now. And so magically, we could see inflation go back down to 2%. That's one thing that could potentially happen. That's what the Federal Reserve Bank is saying, and that's what they want to do. The alternative is, well, we hit the middle part of 2022, and inflation does not get better. And if it does not get better, and we're still seeing high inflation, well, now we might be forced to fight inflation. And if the Federal Reserve Bank is forced to fight inflation, well, what do? Well, they're going to have to contract the money supply. The way they do that is by raising interest rates. And so if we start to see interest rates rise, well, that could affect stock prices, real estate prices, and the entire economy, because our entire economy right now is pretty much reliant on this free, cheap money. People need cheap mortgages to continue supporting housing prices, and businesses continue to borrow this cheap money because that's the way that they can grow right now. And so if, hypothetically, let's say that mortgage rates go up to 6% a year, which still historically is not that high, but let's just assume that mortgage rates go up to even 5 or 6% a year. Well, if that happens, that home that you wanted to buy for $450,000, it's going to cost you a whole lot more money because, well, buying a $450,000 home at a 5 or 6% mortgage rate is going to cost you significantly more than buying a $450,000 home at a 3% mortgage rate. If you're putting 20% down, that means you're getting a loan for $360,000. Well, at 3% a year, it's going to cost you $1,500 a month. But at 6% a year, it's going to cost you almost $2,200 a month. So we're talking about a difference of $600 to $700 a month for the exact same home, just with a higher mortgage payment. Now, a lot of people are not going to be able to afford that $450,000 home anymore because mortgage payments will be higher. So now, if we have home prices that are so inflated and mortgage rates start to go up, well, then people are going to be less likely to go out and buy a home because it's going to be more expensive to go out and buy a home, which would affect the housing market. That's one of the reasons why the Federal Reserve Bank is so hesitant to raise rates, because they don't want to cause a crash in the real estate market. They don't want to cause a crash in the stock market. They want to see a boom in these markets, especially as we're entering a midterm election in 2022. But this is one of the things that's holding them back from actually trying to fight inflation. And so in turn, what ends up happening is the average person pays the price through inflation, because now your cost of living is way more expensive now than it was before. This is where I also want to differentiate between CPI, which is the consumer inflation numbers, and then the business inflation numbers. Wholesale inflation, sometimes referred to as PPI. this is a different inflation number because now if I'm a business and I'm selling you a product, if I have to raise the price of the product, that's a price that you have to pay. But now, if I have to pay higher money, if I have to pay more money to get the raw materials to produce this product, that's a different inflation. That's an inflation for me, the business owner. So there's a different inflation for the consumer, and there's a different inflation for the business owner. I'm sure you've heard people, maybe your cousin Bunty, say something like, oh, the reason why prices are so expensive now is because greedy business owners are charging more money. It's the business owner's fault. But if you dig a little bit deeper, you'll see kind of what's going on. After the CPI data came out and it said that now consumers are paying almost 7% more today than they were a year ago, that's when the business inflation numbers came out, the wholesale inflation report. And that said that businesses are paying almost 10%. 9.6% more today to buy the raw materials for the products than they were a year ago. Here's what that means. Businesses were forced to pay higher prices to produce their products because of inflation, and the Federal Reserve Bank and the government kept telling businesses, don't raise the price of your products. This inflation is transitory, so don't raise the price of your products. It's not going to look good for you. And businesses listened. They didn't raise the price of their products as much as their actual costs went up. So now we've hit a point where consumer inflation is high, but it's still not as high as the inflation that the business owners are paying. You had CPI at 6.8% and wholesale inflation at 9.6%. So what does that mean? Well, now that the Fed has admitted that inflation is not transitory, that probably means that business owners in 2022 are going to say, okay, we have to do something about our higher prices and our higher costs because we can't just keep running with these lower margins. So that might force a lot of businesses now in 2022 to raise the price of the products even more to match the higher costs that they've been having to pay, because up until now, they've been eating that spread. So yeah, you're absolutely right. Greedy business owners have been raising the price of their products, but they haven't raised the price of their products enough to match their rising cost to produce their products. This is where you have a lot of finger pointing of people blaming somebody else for the root cause of inflation. If you listen to any of the congressional hearings, it's horrible. I mean, nobody makes any sense. They're just playing politics. Nobody wants to actually talk about the real root cause of inflation. But the real cause of inflation comes down to one thing. Inflation comes from the word inflate, to increase. What are we increasing when we have inflation? We're inflating the monetary supply. That is controlled by the Federal Reserve Bank. When the Federal Reserve Bank does quantitative easing, when they do bailouts, when they print free money and they inject that into the economy, well, now there are more dollars floating around. And when the Federal Reserve Bank has low interest rates, that encourages companies, people to go out and borrow money, which produces more dollars that come into our economic system. Both of these things cause more inflation by definition. Now, what does this do? It dilutes the value of the dollar. The value and buying power of the dollar goes down, which in turn then causes the price of things to go up. The price of things to go up is a symptom of inflation. It is not inflation in and of itself, but this is where you have to understand. The higher spending by the government is then funded by the Fed. So the government spends money that they don't have, and they get that money through the Federal Reserve Bank, because the government could raise taxes, and they say that they want to raise taxes, but they'll never be able to raise enough taxes to cover all of their spending. So then when the government wants to spend more money without covering it through taxes, well, then the Fed covers it. So then the Fed covers it, the government spends a whole bunch of money, you're happy for a minute, but then your groceries are more expensive and your rent is more expensive. Why? Because of inflation. The value of a dollar has gone down. This is why inflation hurts the people who are financially uneducated, and it hurts the average person. But the person who benefits is the person who's financially educated and the wealthy. And then on top of that, to make matters a little bit more confusing, our economy is in a very weird place. So on one hand, we have the unemployment numbers finally falling. We just saw the biggest drop in unemployment in decades. We saw a 52-year low in unemployment filings, which is great. People are going back to work. People are not filing for unemployment the way that they were before. But at the same time, we have productivity of people at a multi-decade low. Labor productivity is at a 60-year low. So what does that mean? People are going back to work, but they're not doing anything productive. So now the question is, what's coming next? What are we going to see in 2022? And I want to talk about this thing called the long-term debt cycle, which is something that Ray Dalio created and talks about and coined. But before I do that, I just want to say one thing. I hope the Federal Reserve Bank is right. Now, I know the Federal Reserve Bank is not a very trustworthy institution. They're not somebody that I would want to put my faith into, but I hope that they're right. I hope that magically inflation goes back down to 2%, because if they are wrong, well, that's going to be bad news for the economy and the dollar. If we hit mid-2022 and inflation is still very high, and then the Fed is now having to do something to actively fight this inflation fire that they created, that they did not stop soon enough, that can create a lot of issues in the economy, the markets. And this wouldn't just be something that's contained inside the United States, because you have major countries around the world that are holding on to trillions of dollars. So it could create a global phenomenon if this inflation gets out of control and we don't do something to stop it, which is why you definitely want to pay attention to what's going on. Ray Dalio is arguably one of the most successful hedge fund managers in history. He built a hedge fund called Bridgewater. The reason why Bridgewater is so successful is because they look at historical data. They look at historical data for thousands of years. They take all these data points, they plot them, and then based off of what's happened in history, that's how they make their investments today. So Ray Dalio has talked about this thing called the long-term debt cycle. Everybody knows that asset classes like the stock market moves in cycles. Every 8 to 12 years, you see a stock market boom and bust. You see these kind of cycles in the stock market. And at the same time, during those booms and busts, you see the economy kind of grow like this. You see booms, busts, booms, busts, booms, busts. What that means is booms are higher than the previous boom, and then the bust makes them come down. But typically, the new bust is not as big as the previous bust. So you kind of see this upward trending boom and bust curve. But what he says is that this upward trending boom and bust curve falls on top of something called the long-term debt cycle. And most people don't know about the long-term debt cycle because you only live through one in your lifetime. What he says is that these small booms and busts happen every 8 to 12 years, but the long-term debt cycle happens once every 50 to 100 years. Over this 50 to 100 years, what he says is that you're going to see the boom and bust in interest rates, because what happens is interest rates start to go up, and then you see a bust in the stock market, the real estate market, the economy slows down, and then the Fed cuts interest rates. And then they cut interest rates, which causes the economy to grow again. Then you see a bust, and then when the bust happens, well, then they cut interest rates again. And this brings interest rates gradually down over that 50 to 100 years. And then interest rates hit zero, and that's when you have to reset. Maybe you see a new currency, maybe you see a new change happen. This is where a massive change happens at the end of this long-term debt cycle. You'll see a change in the economy. You might see a change in the currency. You'll see a difference, a change in the way that the country and the civilization is run in order to now rebuild it back up. And what he's saying is we're nearing the end of this long-term debt cycle. That's part of the reason why he keeps saying that cash is trash, and why he keeps talking about the importance of investing in money right now, especially during a time where you have all this high inflation. But just something for you to be aware about, because this is something that's very interesting, and it doesn't look like this inflation is going to slow down. I mean, I know the Fed says that inflation is going to magically just go away by the middle part of 2022, but we'll see if that actually happens. Hopefully, at the very least, inflation will cool down significantly. That way we can kind of just calm some of these fears and worries about the dollar. But we'll see what happens. But this is why you need to be financially educated and make sure that you're using your money as a tool. That way all of your cash is not just being eaten away by inflation. So this is why you want to be financially educated. And if you want to learn more, we have a free ebook about how to invest your money in the stock market. This guide goes over how to invest your money in the stock market, different stock market strategies, and how to build wealth in the stock market. So if you want to read this guide, it's completely free when you sign up for a daily newsletter. And you can read the guide by clicking the link in the description below.
Bitcoin has no actual value, right? It's just a string of digital numbers that does nothing in the real world. I mean, you don't actually have any utility out of a Bitcoin, right? If you just have Bitcoin, you can have all 21 million of them and you can't do a thing with them.